It was a year that started full of unknowns. From the reality of a Trump presidency, to the risk of rising populism in Europe, to fears of a China slowdown, 2017 appeared to present a series of market-moving possibilities, higher in what the boffins call downside risk. But, in the end, it was a year that was more remarkable for its lack of volatility and a comeback shared across economies the world over. Here's how it played out. As anyone who follows Donald Trump on Twitter will have been frequently reminded this year, the US stock market is booming. Wall Street hit records nearly as frequently as the president hit the tweet button. The blue-chip Dow Jones Index broke through 20,000 points for the first time in late January. The Dow finished the year 25% higher, while the broader S&P 500 index rose nearly 20%. Technology stocks were standouts. Facebook, Amazon and Netflix all gained more than 50% over the year. Investors spent months anticipating the Republicans' corporate tax cut plan, and it was finally delivered in December, in a major legislative victory for the president. But market watchers say Mr. Trump can't take all the credit for the rally. Henderson Maxwell's Tony Davison said the president's contribution has been largely to do with improving sentiment. The two things Donald Trump can claim credit for are a vastly improved level of business optimism in America and a willingness to test the conventions, he said. Capital chief economist and head of investment strategy Shane Oliver said, while the president has spurred some of the optimism through easing regulatory burdens and cutting taxes, it was just a US story in 2017. The main drivers have been a rebound in US profits on the back of stronger economic growth, he said. This has pretty much been a global phenomenon which has seen all share markets put in strong returns in 2017, not just the US. In 2017, the economic bounce back became truly broad-based for the first time since the global financial crisis. While the US has been on the rebound for some time, other previously uncertain economies finally found firmer footing. Europe has strengthened, which, with ongoing strength in the US economy, means two big engines for global growth are firing, said Ivan Kohlhoff, NAB's chief economist, markets. While much has been made of the synchronized lift across the globe, Westpac's chief economist Bill Evans said one factor outweighs the others from a local point of view. From Australia's perspective, the key development has been the faster than anticipated growth in China, he wrote. The World Bank expects China's economy to have grown at a healthy 6.8% in 2017. But with the rewards come risks. Mr. Evans sees China as the biggest unknown looming in the years ahead. Australian equities rode the rising global tide in 2017. Higher commodity prices provided a boost in the second half, as stronger demand and tighter supply buoyed iron ore and oil prices. In November, the ASX 200 hit 6,000 points for the first time in nearly a decade, breaking through the psychological level that has eluded it since the GFC. But the ASX underperformed its global peers, as negative sentiment in our market's biggest sector put a lid on gains.